your view on what we're hearing from the central banks?
Good morning, Karen. I think that it's inevitable. Central banks need to tighten further. Inflationary pressures are much stickier and more prolonged than what they had initially expected. And core inflation is rising in some of the leading economies, even in an environment in which we have seen commodity prices come down for a few months. So the problem of inflation is significantly more important than a mild recession or the risks of a slowdown in the economy. And central banks need to tighten further. So I think that the message is almost unequivocal. They have said and repeated that it's the biggest priority, the only priority, to be fairly honest, and that they need to tackle this problem because, and I think that this is what market participants tend to forget, is that central banks know that they have reacted way too late and too little. But they also understand that if they don't act on inflation quickly, the problem of stagflation is a much larger problem for all economies, because both on the fiscal and on the monetary side, stagflation is extremely difficult to tackle. So it's better to have a little bit of pain for a few months, even though investors might not like that, than to go through a prolonged period of pain, which would inevitably lead to massive losses, both on nominal and on real terms, in pension funds, in different equity and obviously bond funds. So very challenging environment. Central banks cannot do anything else but tighten. And now we need to see the second phase of tightening, which is reducing the balance sheet of central banks. Remember that the ECB, Bank of Japan, the Bank of England, the Fed, basically have done very little in reducing their balance sheet.
Is there a problem in getting to that scenario, though, Dan? Because it feels as though we've got a massive roadblock in the way in form of governments and voters. You think about the fragmentation of politics that we've had globally over the last few years. It means there's very little wiggle room for some of these governments on policy action. But we've seen it through the lens here in the UK in particular. Perhaps we'll see it in Europe and maybe even in the United States, that governments feel obliged to step in a cost of living crisis and do something so that they're not tossed out next election. But that undermines the pathway, doesn't it, for central banks? And it does make me question whether we're back to those Volcker years where you do actually have a couple of recessions now coming and not a short, brief period of pain as you describe.
It is a very big risk, Karen. You're absolutely right. It is a very big risk because governments are acting on a almost unanimous way, as if increases in yields and increases in rates were not happening. We're seeing governments present plans to tackle inflation that inevitably involve massive increases in spending. Deficit spending is becoming stickier. Remember that most of governments announced large spending plans in 2020 because of the COVID-19 crisis. And now they have found themselves in a situation in which the deficit of 2020 has barely been reduced in many cases, and they're going to increase it again. Most of them by a higher spending, by a higher current spending. And a deficit is a deficit. Doesn't matter if it comes from tax cuts or if it comes from spending. Furthermore, it's worse if it comes from spending because it tends to get to stick. So the problem that I find is that governments don't seem to be paying attention to the news that are coming from the markets.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.